What's up everyone, it's Caddy with Money Investing. We're going to be talking about Netflix in this video and their earnings and how that impacts the market. So hope you guys enjoy it, find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. And the link to our Discord and Patreon is going to be down below with that 16% annual discount also available. So Netflix here, after hours was down a little bit over 10%. So definitely selling off quite a bit with a very, very significant wake on the downside. And in fact, if you come over to the 5-minute chart and 1-minute chart, you'll notice that this big dip happened as soon as the company reported earnings. And for the first 3 minutes, it pretty much ended up selling off quite aggressively and then immediately got bought back up and then rallied all the way back up to $339, pretty much trading exactly where it was before the earnings were released. So very, very volatile price action from Nvidia after hours. And it was a little bit of a mixed results, which I'm going to break down in this video. But first things first, Netflix is a pretty big component of the overall market. Its market cap is a little bit over 148 billion, which, yes, compared to big tech is peanuts, but it is still considered as a FANG stock. And it is a very significant sort of signal or an indicator of how tech and streaming and advertising is going to do, right? Because it pretty much focuses on those areas of the market, right? Consumer spending, discretionary spending, a lot of that is a pretty significant signal to how the market, the rest of the market and rest of tech stocks are going to do. So it's a very telling stock, and it's usually the first ones to actually report. Of course, tomorrow we've got Tesla reporting as well. So Netflix does delay password sharing crackdown rollout and posting mixed results. So EPS came in a little bit over $2.88 versus $2.86. So we got a beat on EPS. We got a miss on revenue, $8.16 billion versus 8.18 billion. So a little bit of a miss on revenue, but beat on EPS. And Netflix reported earnings of $1.31 billion, which was down from $1.6 billion same time last year. So on a year-over-year basis, we did see earnings decline. Now, here's the thing, right? I mean, a lot of the analysts have already lowered their estimates on a lot of these stocks, or a lot of these companies. And that's why it's very easy for us to look at this number and be like, hey, Netflix beat on EPS. It's a strong beat, right? 288 versus 286. But the reality is they're still coming down. They're still lower from same time last year. And there's nothing wrong with that. This is not like a bad thing. It is something that we already did expect, right? Year over year, we know earnings are going to decline for a lot of these companies. And then S&P 500 on aggregate basis expected to decline by over 5 to 6%. We've already talked about it on the channel. And revenue did increase, so that's a positive there. Netflix on Tuesday posted mixed financial results and said it was pushing back its broad rollout of its password sharing crackdown, and that's been a big issue for the company because people have been using one account, and then a lot of people are using the same account, family members using the same account, so they're not creating their own separate accounts. So while this means that some of the expected membership growth and revenue benefit would fall in Q3 rather than Q2, we believe this will result in a better outcome from both our members and our business standpoint, company said in the earnings release. And co-CEO Greg Peters says, and I quote, "The launch in Q2 will be broad, including the US and the bulk of our countries when we think about it from a revenue perspective." And he mentioned that link in the page sharing transition to that of increasing prices. Subscribers initially balk and cancel, then slowly return to sign up for their own account. So that's really what's going to happen is that when they do eventually roll this out, which looks like it's going to happen in Q2, the launch in Q2 will be broad. What's going to happen is in the short term, it's possible that we do see a lot of cancellations for Netflix because people don't want to, sign up, or people won't be able to sign up because of having that access to Netflix under somebody else's account. So once that is taken care of, then you might see for Netflix short-term cancellations, but then eventually over the long term it might be beneficial for the company as everybody signs up with their own email, with their own number for their own account and start paying whatever it is, a small amount, $5.99, $6.99 for the ad-supported tier. In February, Netflix outlined the password sharing guidance in 4 countries, New Zealand, Canada, Portugal, and Spain. And the company said it would ask users in those countries to set a, quote, primary location for their accounts and allow users to establish up to 2 sub-accounts for those who don't live in their home base for extra fees. Netflix said that it has been pleased with its push to mitigate password sharing In Latin America, the company said it saw cancellations after the news was announced, which affected near-term growth, but Netflix added that those password borrowers will later activate their own accounts and add existing members as extra members accounts. As a result, the company said it's seeing more revenue. And that's one of the reasons, one of the ways that Netflix is going to drive revenue is by simply just upselling this as a new product offering, right? Nothing really has changed. People still have access to Netflix. It's just an additional upsell for Netflix where you can add a member for a small fee, right? $4.99, $5.99, whatever it is. And Canada, which will likely be serving as a template for the US, has seen its membership base grow due to the launch of paid sharing, and revenue growth has accelerated and is significantly growing faster than that of the US. So that is something to think about as well. And last November, Netflix also unveiled its cheaper tier with commercials, which costs about $6.99 a month, and the ad-supported tier came shortly after it lost subscribers as streaming competition ramped up. So two things that they're really boosting is, of course, password sharing, which is going to be an upsell through extra members, and ad-supported tier, which is, again, going to be another way to boost revenues and profitability. And they also mentioned that Netflix ad-supported plan now has an average 95% of the same content as what it is on the commercial free plans due to recent licensing deals. And the only difference is that on the ad-supported tier, you're obviously going to see ads. It's actually quite a genius business model, isn't it? Like, you're paying to watch ads. Absolutely crazy. Like, usually it's like you're paying to avoid ads, but in this case, for Netflix, you're actually paying to watch ads. Just wild. This right here is going to be the revenue number. So what you've got here is an increase year over year of 3.7% to $8.1 billion. That's coming from $7.8 billion. Operating income was $1.7 billion. That's down from same time last year from $1.9 billion. Operating margins were a little bit shy, 21% versus 25.1% same time last year. And net income was also lower from $1.6 billion down to $1.3 billion. And as a result, EPS also down on a year-over-year basis from $3.53 to $2.88 for the company. Now, global streaming paid memberships did grow 4.9%. That's the only bright spot in my opinion. So net additions was 1.75 million to 232.5 million total now, which again is a new high for Netflix's paid memberships. And free cash flow was 2.1 billion, which is substantially higher than same time last year. And net cash provided by operating activities, $2.1 billion. Shares outstanding are 452 million at the moment. And this is going to be their forecast. They're guiding for $8.2 billion in revenue, but still expecting quarter over quarter and year over year significant decline in earnings per share. So that is, again, going to be something that's a bit of a highlight. They're expecting lower EPS and lower net income of $1.2 billion for the company, which is going to be lower from same time last year as well. Now, they still do control majority of the market share, and it looks like they have taken some, well, in the US at least, they don't. In the UK, they do. 9% is owned by Netflix in terms of share of the view, in terms of market share as of March 2023. Brazil, there's a competition between YouTube and Netflix. Well, YouTube definitely kind of beating Netflix in that market. Mexico, same story. The US, it's kind of head-to-head, right? So we've got Disney, Hulu, 5%, Prime Video, 3%, YouTube TV, 8%, Apple TV is nowhere to be found yet. And we've got, of course, US at 7% Netflix market share, and UK pretty dominant over in that area. So that's how we're kind of lining up at the moment. YouTube still has a better edge over Netflix in terms of Brazil, Mexico, the US, and of course other areas. Poland, it's pretty head-to-head between YouTube TV and Netflix as well. Now, this right here is going to be the numbers. So revenue coming in at $3.6 billion as of the first quarter 23. Again, that's in the United States, Canada, and North America, and that is higher on a year-over-year basis. Now, that is a good thing, right? I think that's one of the reasons why the stock did rally back higher after hours is because their US, Canada revenue did increase on a year-over-year basis, and average revenue per membership also increased year-over-year, but is declining for the last 3 quarters. So 1637 to 1623 to 1618. So that number is coming down. And this number, in my opinion, will continue to come down as we do get a bit of a mix between password sharing and ad-supported tiers. So it's possible that average revenue per membership comes down, but the amount of members increase from 74 million to maybe 75, 80 million in the future But that's going to be that shift that happens in Netflix's average revenue per user, and then at the same time, their paid users as well. Europe, Middle East, and Africa. Revenue was pretty stagnant on a year-over-year basis. They added close to 0.64 million or 640,000 people in Europe, Middle East, and Africa, 77.37 million. So once again, hitting a new high in that market. And average revenue per user was down not only, it was down on a year-over-year basis from 1156 down to as low as 1089 for the company. Latin America, revenue slight increase. We did lose members there internationally, and 41.25 million is the total paid memberships. And we did see average revenue per user increase for the company. And I think that's what we're really going to potentially see the opposite of that play out in markets like US and Europe and Middle East and Africa, where we do see the members increasing, but the average revenue per user coming down. In Asia Pacific, revenue slight increase. We did see paid net additions, 1.46 million, so lots of additions there. And total members growing to $39.48 million for Netflix. And this right here, of course, is going to be the fundamentals for the company. So a little bit of a decrease in earnings and operating income and net income, slight increase in revenue. Cost of revenues decreasing a little bit on a quarter-over-quarter basis, but of course higher on a year-over-year basis. And marketing expense was pretty flat. Technology and development was slightly higher, and then we did have general and administrative expenses, which were slightly higher as well. And as a result, slightly lower operating income and slightly lower net income as well. And as a result, lower EPS for the company. So, in terms of the actual fundamental value for Netflix, long term, it's definitely got a lot of potential if it can execute well on two things: password sharing and of course ad-supported tier. But my fair value is still gonna stay put, in the 200s, and that's where I would be a lot more interested in Netflix, and support level is gonna stay put at 276. Now for tomorrow, it's possible that, given how we ended the day with lots of sentiment coming back in for Netflix, it's possible that we do see some momentum back higher and some buyers to step in and kind of digest this report. But couple takeaways for me: year over year, we're still seeing a bit significant decline on earnings, operating income, net income. And they also mentioned they're going to be burning close to $17 billion in 2023 for content. I think it's 2023 or maybe 2024 on content. They're going to be spending a ton of money, and valuation still seems a little bit on the high side. But on the plus side, lots of potential for the future growth here. Revenue expected to increase, maybe not in 2023, but in 2024, considering the ad-supported tier and the password sharing is up and running. And those things will definitely have an impact on the company's overall financials. So resistance is going to stay put at $379 to $380. Support level 275, 276. Going into tomorrow, it's possible that we do see some more momentum to the upside, and buyers get a little bit more excited about Netflix's earnings. But my fair value is going to stay put in the low 200s. Nothing's changed as from my previous analysis that I recently did on Netflix. So hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel. Let me know your thoughts on Netflix and what do you make of these earnings. Tomorrow we've got Tesla. So again, make sure that you do drop a like, subscribe, link down below for our Discord and Patreon, 16% annual discount. So always happy investing, and I'll see you all in the next video.